Welcome to Global Experts Network Learning Platform. I am pleased to guide you through Module 15, focusing on LBO and acquisition modeling. In this deep dive session, we will master the mechanics of leveraged buyouts, deal structuring, and the complex analysis required for successful M&A transactions. This module is designed to give you the practical skills needed for high-level financial modeling. Module 15, LBO and acquisition modeling. Leveraged buyouts represent one of the most powerful tools in finance. By using significant amounts of borrowed money to meet the cost of acquisition, financial sponsors can achieve outsized returns on their equity investment. Today, we will explore every step of this process, from initial purchase price calculation to final exit returns analysis. Our learning objectives are ambitious. We will master building complete LBO models from scratch, structuring complex acquisition financing packages, and calculating critical return metrics such as internal rate of return and multiple on invested capital. We will also model management equity packages and analyze various exit strategies, ensuring you have a 360-degree view of the transaction lifecycle. Before we delve into the spreadsheets, it is crucial to understand the philosophy of value creation in a leveraged buyout. It is a common misconception that LBOs are purely about financial engineering. While leverage is a key component, true value is often driven by operational efficiency, strategic focus, and the discipline imposed by a heavy debt load. Value creation typically stems from several distinct sources. Debt paydown is a primary driver, often contributing 30 to 40% of the value. As the business generates cash and pays down its debt, equity value increases. EBITDA growth through operational improvements provides 40 to 50% of value, while multiple expansion, selling at a higher multiple than you bought, adds 10 to 20%. Let's look at the geometry of a typical deal. In this $800 million example, the sources show how we fund the transaction. $400 million in senior debt, $120 million in subordinated debt, and $280 million in total equity. On the right, the uses account for every dollar, $720 million for equity purchase, and the remaining for refinancing and fees. Structuring the sources and uses is one of the most important tasks for a modeler. You must balance the need for leverage to boost returns with the necessity of maintaining enough financial flexibility so the company can withstand economic downturns. Over-leveraging can destroy a good business, while under-leveraging can result in mediocre returns for your investors. Calculating the purchase price is our starting point. We define enterprise value as the purchase multiple times the last 12 months EBITDA. In our working example, a $100 million EBITDA at an 8 times multiple yields an enterprise value of $800 million. From this, we subtract net debt and add cash to arrive at the equity value. The capital stack is layered by priority and risk. Senior debt sits at the top, typically 40 to 50% of enterprise value, with interest at SOFR plus 3 to 4%. It is the cheapest capital but has the first priority. Subordinated debt sits in the middle, offering higher interest rates for higher risk. Equity sits at the bottom, bearing the most risk but capturing all the upside potential. In an LBO, debt is the lever that amplifies returns, but managing that debt requires a detailed schedule. We need to track exactly how much cash flow is available each year to reduce the principal balance. This amortization is what shifts the value from the lenders to the equity holders over the life of the investment. Observe this 5-year debt paydown schedule. Starting with $400 million, the company makes mandatory payments of $20 million annually. But the real power comes from the optional prepayments, the excess cash swept to pay down debt. By year 5, the debt balance has shrunk from $400 million to just $100 million, representing a 75% reduction. The cash sweep mechanism follows a strict priority. First, we satisfy mandatory debt amortization as required by the credit agreement. Second, we maintain a minimum cash balance, usually $20 to $50 million, for working capital needs. Finally, every single dollar of excess cash is swept to make optional prepayments, accelerating the deleveraging process. After modeling the operations and the debt paydown for 5 years, we arrive at the most critical part of the model, the returns analysis. This is where we determine if the investment meets our firm's hurdle rates. We look at the total cash returned relative to the cash invested, adjusted for the time value of money. At the end of year 5, we calculate the exit enterprise value by applying an exit multiple to the terminal EBITDA. In our example, a 9 times multiple on a $150 million EBITDA yields a $1.35 billion valuation. After paying off the remaining debt, the equity holders are left with $1.3 billion, resulting in a 36% IRR. Private equity firms rely on a specific set of metrics. IRR is the time-weighted primary metric with a target of 20 to 30%. MOIC, multiple on invested capital, is the secondary metric, targeting 2.5 to 3 times. We also track cash-on-cash returns and DPI, or distributed to paid-in capital, to measure the actual cash flow back to our limited partners. No model is complete without a sensitivity analysis. A single-point estimate of a 36% IRR is dangerous because the future never unfolds exactly as planned. We need to stress test our assumptions. What if growth slows down? What if exit multiples compress? Sensitivity tables help us visualize the range of possible outcomes and understand our margin of safety. This matrix shows how the IRR changes across different growth rates and exit multiples. Even in a downside scenario where the exit multiple drops to 8 times and growth is only 4%, the model still yields a 22% IRR. This helps us confirm that even if our assumptions are slightly off, the investment remains fundamentally sound. Alignment is everything in an LBO. Typical management packages include 5 to 15% ownership of the post-deal equity, often vesting over 4 years with a 1-year cliff. This structure ensures that the executives running the company are incentivized to achieve the same exit goals as the financial sponsors, aligning interests across the board. You must always start with the end in mind. While we focus on the entry, the exit is where the profit is realized. Different exit paths offer different timelines, costs, and valuation multiples. A sophisticated modeler will evaluate multiple exit scenarios to understand which path offers the best risk-adjusted return for the equity holders. Our exit options include a strategic sale, which often commands a premium multiple of 9 to 11 times, a secondary LBO to another private equity firm, an IPO, which offers the highest potential multiples but with significant costs and longer timelines, or a dividend recapitalization, which returns cash to investors without a full sale of the company. In strategic mergers, we perform accretion and dilution analysis. This determines if the pro forma combined earnings per share is higher or lower than the acquirer's standalone EPS. Factors like the purchase price, the amount of synergies realized, and the method of financing, whether cash, debt, or stock, are the primary drivers of this analysis. Synergies are often used to justify the premium paid in a merger. Revenue synergies come from cross-selling products into new markets, while cost synergies come from eliminating duplicate overhead. We typically model these with a phase-in period, perhaps 25% in year 1, 50% in year 2, and 100% by year 3. As we conclude, I want to leave you with some practical modeling tips. LBO models are complex and prone to errors. Discipline in your spreadsheet structure is your best defense. We must also handle technical challenges like circular references, which arise because interest expense depends on the debt balance, which in turn depends on net income. The solution to this circularity is simple but vital. Enable iterative calculation in your Excel settings. This allows Excel to run the calculation multiple times until the numbers converge on a stable solution. Without this setting, your model will break as soon as you link your debt schedule to your income statement. Always build from historical financials and model conservative assumptions. Include a comprehensive debt schedule and build flexibility into your model so you can toggle between different scenarios. Clear documentation of your assumptions is just as important as the formulas themselves. It makes your model auditable and trustworthy. For maximum efficiency, use separate tabs for assumptions, financial statements, and debt. Color code your cells. Use blue for hard-coded inputs and black for formulas. This industry-standard formatting helps others quickly understand your work. Finally, always include a summary dashboard to highlight the key metrics and returns. The key takeaways are simple. LBOs create value through debt paydown, operational growth, and multiple expansion. Targets of 20 to 30% IRR are the benchmark for success. Management alignment is crucial, and exit flexibility is the key to final profit realization. Master these concepts, and you master the heart of private equity finance. In summary, we have covered capital structure, debt schedules with cash sweeps, IRR and MOIC calculations, and management equity modeling. This Module 15 mastery provides the foundation for your continued success in M&A analysis and high-stakes deal modeling. Continue practicing these techniques to refine your expertise. Thank you for completing this comprehensive look at LBO modeling. I hope this knowledge empowers your career. Please subscribe to the SNB Experts YouTube channel to stay updated with our latest financial training modules and cinematic projects. Join our growing community of experts. Goodbye, and see you in the next module.